So it's related to the economic reforms. It's related to the economic reforms. So economic transformation, basically we will be covering the data related to different sectors, whether it is related to the transformation in the real sector or economy sector or agriculture sector. So we will be covering all of these. Okay, so first of all, it is related to economic transformation under real sector. So first of all, there was related to deregulation of the industry by way of eliminating the licensing requirement. That particular condition was deregulated, and further taking over of the public enterprises. The public enterprises were taken over by the government itself, and the private sector role was further enhanced. The MRTP Act was abolished. So monopolies and restrictive trade policies, those were basically abolished. There was automatic approval route for the foreign investments, for the foreign investors who wanted to invest into the Indian economy itself. There was an automatic approval route for most of the transactions, and if there is any kind of the approval that is required, that is also available with the minimal interference. Okay, and for the elimination of the quantitative import restrictions. So if you want to import in quantity, the restrictions were basically eliminated, and there was reduction in the tariff rates too, and also de-reservation of large number of items that were earlier meant to be produced exclusively in the small scale sector. So let me tell you in brief that further there were the number of items which were available in the market, and there was a restriction that those items can only be prepared by the small scale sector, and that particular reservation was basically removed. Okay, and for the liberalization of foreign direct investment, and there was no basically related to the any there was no limit related to that. Okay, so that is related to what? That is related to the real sector. Next sector, it is related to the service sector. What were the reforms related to that? Let us have a look at it. So you just need to get an idea related to that. What were the reforms? You need not to cram it exactly. Just get an idea in a story mode that what were the different reforms over there. Okay, and try to just keep those things in your mind. That's it. That's you all need to do for this particular unit. Okay. Then it is related to the services sector. So entry of the private sector and the foreign direct investment has introduced the competition. So previously there was monopoly, and further only and only the government institutes were available over there. But now the private sector and the foreign direct investments they invested into this particular sector, into the service sector, and that basically led to the competition itself. If we say that we must be basically shutting down all the private banks, what does actually it will lead to? It will lead to the monopoly of the government banks, and further we already know that the services being provided by the private sector banks, it's quite competitive. Okay, and further that gave a sense of knowledge to the other banks, that is the PSBs, that they also want to provide the same level of the services to their customers. Further, it is related to liberalization of the financial sector with entry of private sector in the areas, and policy initiatives with regard to information technology led to surge in the growth of the service sector. So there was two reasons beyond related to the we can say growth in the service sector. That was related to, first of all, it was related to that the private sector was is now the main party in the service sector, and secondly it is related to that informational technology is now being used in the service sector. That basically led to that there is a huge growth in the service sector. Further, the boom in information technology and ITES, that is a information technology enabled services sector, led the era that is service led growth, and India emerged as the global hub of the BPO and the KPO services in the world. Okay, so that was only and only possible due to the information technology and IT enabled services. Is that clear? And further, let us have a look at that the advantages of the low wage structure, because over here in India a huge population is there, unemployment rate is very large, due to which low wage structure is over there. Flexibility is there due to the time zone differences, and access to a larger and better talent pool provide global active compliances, global active companies. The idea that they can hire the persons over here at a very low wages over there. That is why India is an ideal place that took off as per the offshoring services, because India is providing the offshoring services, and further the services are being provided by the persons over here in India, because those are available at the very low wages. Okay, Second, it is related to the India IT or ITES, that is the Information Technology Enabled Services industry, has contributed significantly to the Indian economic growth in terms of GDP. So we will be covering all about the GDP in the next to next unit. That is all related to the GDP concepts. So India basically the service sector contributed significantly into the GDP in the foreign exchange earnings and further related to the employment generations. Is that clear? Okay. Further, it is related to agricultural sector reforms. Agriculture sector reforms. Now we know that agriculture sector reform, if we look at that particular factor, I already told in the previous video that also the 64% of the population, 64% of the population is employed in agriculture. It's employed in agriculture. Rather, the part related to the agriculture, it's only and only 17% share in the GDP. Okay. So measures relating to free movement of the agriculture community, there should not be no restrictions. And for the APMC Act, that is the Agriculture Produce and Market Committee, permitting the farmers to bypass the mandatory requirement of sale in the regulated market. So previously it was required by the farmers that they will be selling their crops into the regulated market only. But now APMC is now what? APMC is now removed. Okay, so APMC Act is not basically not removed. It is basically a way that the farmers are bypassing the criteria that they are to sell their crops into the regulated market only. So now that criteria is not to be fulfilled by the farmers due to the APMC Act. Further, relaxation of restrictions under Essential Commodity Act. So relaxation of restrictions under the Essential Commodity Act, it is not now required. It is not now required that they are to produce only and only the same crop. So there is some relaxation related to it. And for the introduction of the future trading, we have already learned related to the different derivatives such as the futures, options. Now they can do trade the commodities in the future trading also. That basically the futures can be used for the speculation purposes and also to get the best prices for their produce itself. Further, banks extend credit to the farmers against warehouse receipts. Previously, this service was not available, but now banks do create the charge of pledge on the warehouse receipts, on the basis of the warehouse receipts, and based upon that the credits have been basically advanced. Okay, and for the large consumer goods companies directly source agriculture produce from the farmers itself. Now let's have a look at the economic transformation, financial sector. Economic transformation related to financial sector. So financial sector reforms have been carried out in accordance with the recommendations. So there were 3 committees and the working group by which the recommendations were given. This was the Narasimhan Committee report on financial sector reforms in 1992 and Narasimhan Committee report on banking sector reforms in 1998. And further, there was a working group under the chairmanship of the S.H. Khan and the report was submitted. There were the recommendations given by them, and the financial sector reforms were basically in accordance with the recommendations of these working groups and committees. Is that clear? Okay, so 3 committees were there. One, it is a Narasimhan Committee report on financial sector reforms 1992, and the other Narasimhan Committee report on banking sector reforms in 1998, and the third one, it is a S.H. Khan report of the working group. Okay, so that is related to the recommendations which were given based upon the financial sector reforms are there. So first of all, let us have a look at the money market. Now, what is money market? Money market is a market where the bank basically borrow the amount or lend the amount for the very short purposes under the interbank market scenario. So it's related to the interbank market scenario. So call money, notice money, term money, all are related to money market. So there are reforms which are aimed at providing avenues for the market players to deploy or access to short-term funds. So all the funds related to the money market are maturing within a period of a maximum up to 1 year. And further, it's basically a market where you can basically borrow if you want to borrow, and if you want to lend, you can lend the money over there and for a short-term period. And deregulation of the interest rates is over there. Deregulations of interest rates over there. Previously, the rate of interest related to the money markets, those were being basically not market driven. Those were basically decided by the regulator itself, but now those are regulated. Now those are deregularized. Further, introduction of new instruments. New instruments like commercial paper, certificate of deposits, these have been introduced for the exemption of interbank lending from the reserve requirements. So if you have basically lent the money from the interbank market, in that case you need not to maintain the reserves based upon that particular money. And further, introduction of the screen based trading, whether it is a capital market, whether it is a money market. Now there is a screen based trading over there for the rupee derivatives such as the interest rate swaps, forward rate agreements. These are now the hybrid instruments, the derivative instruments which are available over there, which can be used for the hedging purposes, and also they can be used for the speculation purposes. Is that clear? We already knew that, we have already covered it under the BFM paper itself, that I told you that the derivatives are those instruments whose value is, who are basically does not have any value of their own, but those whose but the derivatives value is driven from the underlying assets. Okay, now these are basically used for two main purposes. One is for safeguarding, that is a hedging purposes. Other one is for the speculation purposes, that is a trading purposes. Is that clear? Further, enlarging the scope of the repo market by expanding the repo table expanding the repoable securities and eligible participants in the repo market. Now there are different repo instruments which are available over there, and further the scope of repo market has been enlarged. Is that clear? So these were the reforms related to the money market. Now it is related to the government securities market. So now the auction system is introduced. And the phasing out the automatic monetization with the ways and means advances. Now the ways and means advances is now phased out and the market auction system is introduced, and further the secondary market activity is now rising. There are two types of market. One, it is a primary market where the government sells the securities itself to the investors through the Reserve Bank of India, and the secondary market is related to that. Let us take the case that the investors have bought the securities from the market, from the government of India through the Reserve Bank of India itself. Okay, now the investors, they want to buy or sell in between them. That is basically related to what? That is related to the secondary market over here. When the securities are being sold directly to the market itself, that is a primary market, and when these securities are sold in between, that is basically related to the secondary market. Okay, now the government security is no longer a captive market. And further there is a latest update by virtue of which you can directly invest into the government securities. Even the retail investors can invest into the government securities. And further, investment in government securities by the banks is based on their commercial judgment. It is based upon what? It is based upon their commercial judgment rather than being dictated by the reserve requirement. Now there is no dictation by the regulator related that the banks are to invest into the government securities. It is based upon the commercial judgment of the bank, that is they want to invest into the government securities or not. Okay, further the pricing of government securities has also become far more market oriented. Now this is market oriented and not basically led by the government itself. Okay, further it is related to the foreign exchange market. So introduction of the market-based exchange rate regime. Let me tell you one thing, that previously there was no free convertibility of the rupee. The capital account transactions and the current account transactions were not freely executable. And further, the regulator, that is Reserve Bank of India, was a sole authority that it was dealing into the sale and purchase of the foreign currency. And further, so as to maintain the value of the rupee, it was a concern of the Reserve Bank of India only, and it was not market driven. Okay, now we have adopted the current account convertibility, and also there is relaxation in the terms of capital account transactions too. Current account transactions, you can say, for the normal business transactions or related to trade transactions to the foreign currency, or it may be the case that you are basically repatriating money for the medical purposes, for education purposes. Those all are basically related to current account transactions. And when I say capital account transactions are those transactions which basically do alter the assets or liabilities or the contingent liabilities of any person who is residing over here in India, and further the assets and liabilities are being altered in the foreign country, or it may be the case that the person is residing over there overseas, and further the transaction alters the assets or liabilities into India itself. Those are all basically related to the capital account transactions. Okay, so if our capital is basically related to it, it means if likewise the case, I can say that if an NRI person has purchased a home over here in India, that is basically what type of transaction? That is a capital account transaction. Okay, there is a relaxation on the account of the capital account transaction, but current account transactions are fully convertible now. Okay, these are fully convertible. That is, there is no there is deregulation in this particular part. Okay. Further, permission to run open position. Now you can have an open position, or you can have an exposure on in the foreign currency. Likewise, if you say that if you want to buy 10,000 USDs, you can do so. You can have an open position, that the authorized dealers can have an open position into the foreign currency, and they can hold the investments abroad also. If they want to invest the money abroad, it is also now allowed, and also they can borrow money from the by the way of ECB, that is external commercial borrowing. The banks are allowed to borrow the money from the overseas lenders, and also they can do buy the instruments so as to hedge their investments. Is that clear? Further, exchange rate is flexible now and is now market determined. Further, the capital account transaction is also effectively convertible. I told you that there is partial convertibility of the capital account, which is also allowed. Further, market forces play a predominant role in determining the external value of the rupee. Now, the market forces are the one who are deciding the external value of the rupee. Now let us have a look at the capital market. Capital market is related to sale, purchase of the equity, securities, debentures, bonds, etc. Okay. So primary market witnessed issuance at free pricing. Previously, what was actually the case, that the pricing was basically maintained, and further it was disclosed by the CCI itself. But now it is not so. There is a book building concept along with the mandatory disclosures as prescribed by the SEBI, that is the Securities Exchange Board of India, that is a karta dharta of the capital market itself. And further, the free pricing is over there. And further, in the secondary market, corporatization of the exchanges is there. There is demutualization of the exchanges now, and the trading is now screen based. And further, the options and futures have been introduced, the derivatives have been introduced, and rolling settlement replacing the 14 days settlement system. Okay, previously there was 14-day settlement cycle, but now there is a rolling settlement. There is a rolling settlement now. And further, dematerialization of securities with the depository system. Now you need not to maintain the securities in the materialized form. You can maintain the securities into the paperless format, that is a dematerialized format, with the depository system itself, like CDSL, etc. Okay. Now there it is related to the reforms of the credit market. So prior to reforms, banking operations both on the assets and liability sides were governed by the guidelines set out by the regulator. First of all, the interest rate was regularized. So the major reform, it is related to the deregularization of the interest rates. So prior to reforms, the banking operations, whether we are talking about the assets, whether we're talking about the liabilities, both were governed by the guidelines of the regulator. And reforms in these markets have been to bring more competition, so as to bring the more competition along with higher flexibility and operational autonomy of the banks. Now the banks are not only lending to the corporates, they are also lending to the retailers. They are also lending to the retail customers itself. So there is a huge basically scope available in the market itself, where the bank can use the flexibility, and further there is more competition available over there, because there is now liberty that has been given to the bank itself. Okay. Further, it is related to stability of emphasizing the building up of risk management capabilities. Now, as per the Basel norms, banks are advised that they must be having some ICAAP, that is related to internal capital adequacy and assessment processes must be there, so as to assess the risk, so as to identify the risk, quantify those risks, and further the risk must be managed by building some internal functions. Reserve Bank of India, that is a regulator, will be supervising those criteria, the controls, and further looking at the different factors that if the banks are capable so as to manage the risk or not. Okay. Then it is related to introduction of the prudential regulation and supervision. Now, widening of ownership due to the stock market listing. Now the banks are the limited. Now banks are what? Private banks, if we talk about, or the PSBs we are talking about, these are now the public limited companies. There is a stock listing of these banks, and we can say the ownership is now widened. It is now not only in the hands of a few people, and further it is now widened, and for the associated disclosure requirements brought greater market discipline and the transparency. Now there is a disclosure requirement on the banks that they need to disclose the different data on quarterly basis, half yearly basis, and further that is bringing more transparency and the market discipline among the market players itself. Okay. Further, next it is related to the reforms related to the payments systems. Reforms related to the payment system. Now the information technology is being evolving day by day. If you look at back to the 10 years, there were very few systems which were available, but now the new technologies are available. Rapid developments have led to basically deeper penetration into the market. You can basically increase your customer base. The bank which was introduced just 7 to 8 year backs, which was basically unknown to everyone. Now each and every Indian, almost each and every Indian has got its application installed there in the phone itself. That is a Paytm bank itself. If you're not about, that is possible due to what? That is only and only possible due to the innovation itself. Okay, so the enactment of the PSS Act, that is the Payment and Settlement System Act, was there in 2007, empowering the Reserve Bank of India so as to regulate the payment systems and supervise the payment and settlement systems over there. Is that clear? So the PSS was enacted in 2007, and further there were the policies, there were the procedures which basically provided a legal framework related to these payment systems. Payment systems were previously also available, but what are the guidelines, how these can be regulated, all the things were basically laid down under this particular acts over there. And then it is related to free usage of the ATMs. Previously it was not available, but from 2009 itself there were free ATM transactions which were permitted to the customers. That is basically related to the interoperability. That's also a quite big reform. And further, the service charges for the electronic payment product and the outstation checks have also been now rationalized. There is a speed clearing which is available. Whether we talk about the CTS system is now there, whether we talk about that the outstation checks now can be cleared within a day or T+0 basis or T+1 or 2 basis, that is also over there. CTS has been introduced and the coverage of the ECS has been increased. Previously the ECS coverage was not that much, but now that has been increased. That is all related to the reforms in the payments and settlement system. Is that clear to you? So there were different reforms that we have gone through, whether it is related to real sector, agriculture sector, services sector, or it may the case of the financial sector reforms. We have covered all these over here. Next, it is related to integration with the global economy. Now the main thing is, because we want to compete in the global economy itself, that can be basically the common measure related to the global economy, that how we are integrated with the global economy, that is related to participation to international trade and capital flows. That how your capital is being flowing into the different countries. Are there major inflows or major outflows? Okay, so if there is basically major outflow, it means what? That you are importing more. And further, if there is major inflow of the cash inflow over there, in that case we can say there are major exports over there. Okay, so the common measures of countries' integration with the global economy, it is basically participation to the international trade. Participation to the international trade and the capital flows over there. Let us have a look at it over there. First of all, it is related to the trade liberalization. So delicensing of virtually all intermediary input and capital goods. So whatsoever the input and capital goods over there, those all have been delicensed so as to increase our exports. And further, progressive deduction in tariff rates with permission for all current account transactions. Now all type of the current account transactions are permitted. I already told you that for the current account transactions, rupee is fully convertible, and also for the capital account transaction, the convertibility is partial, and further it is now relaxed. Okay, and expenses for the education, medical, foreign travel has enabled India to accept the IMF Article 8 obligation. Now basically all the expenses which are basically related to the current account transactions are now fully convertible, and these have been enabled. All the expenses have enabled the India to accept the IMF Article 8 obligation, thereby making rupee convertible on current account. Is that clear over here? That is related to the Article 8 of the IMF. You must be aware of that. Next, it is related to capital account transactions. Capital account transactions move towards full capital account liberalizations has been calibrated with extreme caution. Why did so? Because if the capital account transaction was fully convertible, there is a huge chances of the loss to the country itself, setback to the country itself. That is why it is approved. It is approved. Liberalization has been there, but that is calibrated very cautiously. Okay, the policy framework for the capital inflows involved supplementing debt capitals with the non-debt capital with a clear prioritization in the favor of the latter. Is that clear? Then it is related to the foreign direct investments. Second point, it is related to the foreign direct investments. Now, there is introduction of automatic approval for the foreign direct investments that empowered the Reserve Bank of India to approve equity investment. So as to approve the equity investment. Then 100% of FDI is permitted. In most of the cases, 100% of the FDI is permitted except for a very limited number of the categories that is related to the retail trading, atomic energy, lottery business, etc. Okay. Otherwise, 100% of the FDI is permitted. Next, it is related to the portfolio investment. So portfolio investment, whether it is related to the primary market or it is related to the secondary market, by the foreign institutional investors, it was opened in 1992. It was opened up in 1992. So Indian companies are permitted that they can raise equity in the foreign currency. By issuing the ADRs and the GDRs. What is ADR? ADR is American Depository Receipt and GDR is Global Depository Receipt. So these basically have enabled the Indian companies that they can raise the equity in the foreign currency itself, and also whatsoever the amount which has been generated in the foreign currency by way of issuing the ADR and GDR, the companies are further allowed that they can invest that particular amount in the foreign countries itself. Okay, and further that for that particular purpose, approval from the RBI is not allowed. Okay. And policy with regard to the FII investment was progressively liberalized. Previously, those were allowed in 1992, but the liberalization was limited. And further, those were basically progressively liberalized. And for majority of sector, the cap is 100% now. So FII, that is a foreign institutional investors, are permitted to invest in the debt instruments issued by both the private corporates and the government itself. They can do invest into the debt instruments which are issued by the private corporates or by the government itself, and they can operate in forward market. They can do operate in the forward market related to the forward contracts so as to hedge the currency risk. They can do undertake the forward agreements or forward contracts. Okay. Next, it is related to ECB, that is external commercial borrowing. External commercial borrowing is a way by which the Indian corporates or Indian companies do borrow from the overseas lenders. Okay, so now permission to access the ECB is over there, and further it is related to corporates have increasingly accessing the commercial borrowings from abroad. Okay, next it is related to outward flows. So outward flows are also permitted. So if the cash inflow is permitted, cash outflow is also permitted. That if you want to invest into the overseas, that is also permitted. So outward capital flows were also relaxed for both the individuals and for the corporate sector itself. Firms can do invest abroad up to their net worth. So they can do invest into abroad up to their net worth plus EEFC holding. If you're having the exchange earner foreign currency holding, if you're having the foreign exchange raised through the ADR, GDR plus your net worth, that you can do invest into the abroad. That is related to the outward flows. Now let us have a look at the different issues and challenges. Which are basically faced by Indian economy. First, the major challenge, it is the poverty itself. So we look at the poverty. And if you want to measure the Gini coefficient, the Gini coefficient is a standard measure. Related to the income or expenditure inequality. And further, it has deteriorated. The more it is, the worse it is. And further, the Gini coefficient has deteriorated from 32.9% in 1993 to 36.2% in 2004. And further, it deteriorated to 47.9% in 2018. If we look at the socio-economic development, the Human Development Index HDI is widely used as an indicator, and further, out of 180 countries, India is placed at 131st rank in the year 2020. As per the 2020 report, as per the HDI, that is a Human Development Index, India is ranked at 131 out of 180 countries. So broadly reflective of the poor performance in the case of the health and education services. It is basically showing respective the individual countries over there, that India is ranked 131. Okay. So now what are the reasons related to the deteriorating health services over here in India? So a transition from high mortality to a state where people generally lead to long and ailment free life, it is a desirable social goal that we all want, that there must be low mortality rate, and people must be leading to a long and ailment free life. And further, there has been significant improvement. It is not so that there is not improvement, there is improvement, but if we look at the part of the GDP which is being invested into the healthcare sector, it is very much low. The different reasons are, first of the population is quite large, and further the per capita income is very low. So different avenues for the government related to the revenues are very low. Okay, so those are some of the reasons. And further, it is related to the agriculture investment. The share of the agriculture in the total income has dropped to approximately 17%. So the share of agriculture in our GDP is about 17%. Still, more than 64% of the population continues to draw its livelihood from this particular sector, that is the agriculture sector itself. But there are urgent reforms that are required over there, that is related to urgent need to enhance the investment in this particular sector if we want to raise the crop productivity, and further so as to create the employment opportunities outside the farming. If we want to create the employment opportunities from the allied agriculture, if you want to create the employment activities from the indirect agriculture, in that case a huge capital investment is required. And further, need to effectively integrate the rural sector with the urban economy. We need to integrate the rural sector with the urban economy so as to create the needed infrastructure. New infrastructure is required, roads must be there so as to connecting it to the rural areas, electricity must be provided to each and every village over there, major and minor irrigation projects must be there, because we must not be relying on the monsoon itself for the agriculture purposes. Cold storage chains must be there so as to provide the excessive so as to provide a place so as to store the excessive of the produce over there. So these are the upgradations, these are the reforms which are required. And further, a requirement felt for bringing the legal reforms with regard to the tenancy rights. So because if you want to do the agriculture on lease based land, there must be some legal reforms related to it. Okay. Further, let us have a look at the labor reforms. There is a need to ensure relatively in the rights of management and workers to promote healthy growth and further the progress. If you want to grow, if you want to progress, in that case, it should not be like that there must be disparity. There must not be disparity among the labors over there, and there must be labor reforms. If you want to have a growth, have a healthy growth and further the progress, the disparity between the organized and unorganized sectors in terms of the working conditions, protection of employees should also be bridged. What does it mean? It means if you are working in some organized sector, let us take the case a corporate is there, IT firm is there, that is a basically organized sector. And if we look at the micro small enterprises, we can say it is a unorganized sector, or we can say this is a decentralized sector. In that case, if we look at the criteria, if we look at the functionaries, that what are the working conditions in the organized sector and what are the working conditions under the unorganized sector, the gap there must be bridged. And for the need to enhance protection of workers, we need to enhance the protection of the workers in the unorganized sector with the provision of insurance, pension schemes, medical facility, etc. Those must be provided to the protection of the workers to the unorganized sector. Further, in emerging markets economies where the labor laws have been rationalized and more awareness have been created in the unorganized sector, it has been basically seen in those economies where there are appropriate laws available, that they have achieved higher growth rates, so that it is basically very much necessary so as to bridge out the gap. Okay. Then it is related to the demographic dividend. What is demographic dividend? So demographic advantage, popularly called as demographic dividend, because most of our population is population is basically related to the age group of the 15 to 20 years, 15 to 20 years, and it is basically keeping on rising. It keep on increasing since 1980s, and further has been projected to be in the range of 62 to 68% during the first quarter of the current century. Okay, so that is the advantage to the Indian economy itself, that most of the people over here are young people, and so as to take the advantage of this, large investment in human capital formation is required. Because human capital, if we look at the factor, if we say that population is large and it's basically bad for us and all the things, you must be looking at the particular factor that if the proper investment is being made on the human capital itself, so as to form the capital out of the human, in that case we can work very well, because most of the population is in the form of the demographic dividend. Okay, then it is a financial inclusion. Then it is related to the financial inclusion. So while a number of steps have been taken so as to achieve the inclusive growth throughout the various financial inclusive initiatives, because we want so as to provide the banking services to each and every household over there are different constraints which are available over there. First of all, it is related to high operating cost in the remote areas, small ticket size related to the weaker section and related to the financial inclusion sector, and for the lack of collaterals and for the illiteracy. So these are the constraints related to the financial inclusions. Okay, and that would be all related to the economic reforms. And that would be all related to the economic reforms. The next unit that we will be covering, it is related to the monetary policy and the fiscal policy. So kindly please wait for a minute so that I could upload the new file, and further we'll be starting related to the monetary policy and the fiscal policy. So here it is. So monetary policy, if we look at monetary policy, is a process by which the government, central bank or monetary authority of the country controls. What does they control? They do control the supply of money. Why it is required? Because we already have learned that if the supply is greater than demand, supply of money is greater than demand, what it will lead to? What it will lead to? So kindly please let me know what it will lead to. Kindly please let me know if the supply of money is greater than demand. In that case, what it will lead to? Why it is necessary so as to control the supply of money? Why it is basically important so as to control the availability of the money? Why it is to maintain the cost of the money or the rate of interest in order to attain the set of objectives? So that will basically lead to what? That will lead to the inflation or deflation. That will lead to the inflation or deflation. So if the supply is greater than demand, that will lead to inflation or deflation. Why it is required? I want you all to answer at the earliest that if the supply of money is basically greater than demand, it will basically lead to fall in price. It will basically lead to fall in price. So in terms of interest, if we look at it, it will basically lead to what? If a huge amount of money supply is available in the market, in that case, the people will not be interested into that much credit now. If we look at it from the bank perspective, let us take the case that the banks are having 1,000 crores of the funds which are basically unutilized funds. In that case, the bank is not able to utilize those funds. Bank is not able to lend those funds. Ultimately, the bank will be lending the funds at lower rate of interest. The bank will be lending the funds at the lower rate of interest. So that is why it is very much necessary so as to control the supply of money, availability of the money, and cost of money or the rate of interest. Is that clear? So monetary policy is that process. So monetary policy is referred to as either being an expansionary policy. So either it would be expansionary policy or it would be contractionary policy. So either it would be expansionary policy or it would be contractionary policy. So expansionary policy is that policy in which we want to increase the total supply of money in the economy. And contractionary policy means we want to decrease the total money supply. That is related to the expansionary policy. And the contractionary policy, if we are basically dealing with the contractionary policy, we basically want to basically supply more money into the market. So as to combat the unemployment in a recession condition by lowering the rate of interest. So if the higher rate of interest is there, and that particular case we will be basically there must be surplus of the money available, so that the interest rates must be falling down. so that the interest rates must be falling down. While in the case of the contractionary policy, where the huge amount of the money is already available in the market itself, that is basically leading to the inflation. So that is why basically the contractionary policy is used. So that is why in that particular case, the contextual policy is used. That is basically related to what? That we will be sucking out the money from the market itself. That is basically related to what? That the interest rates will increase. That the interest rates will increase, and further it helps us to combat the inflation. It helps us to combat the inflation in a way. Okay, so that is related to the expansionary policy and the contractionary policy. Is that clear? Okay, so monetary policy is contrasted with the fiscal policy. Now we will basically learning about the fiscal policy also, that is related to that what would be the budget related to, what would be our revenues and what would be our expenditures, that is related to that. It is also related to somehow that what the government will be borrowing and what the government will be spending, and ultimately what would be the taxation related to. And monetary policy is contrasted with the fiscal policy. Okay, so the fiscal policy is related to what? That what is government borrowing, what is government spending, and what is the taxation related to it. Okay, now let us have a look at the tools of the monetary policy. Let us have a look at the tools of the monetary policy. First of all, it is related to the bank rate. First of all, it is related to the bank rate. What is bank rate? Bank rate is a discount rate, is a rate of interest which the central bank charges on the loans and advances that is extend to the commercial banks itself. That it basically extends to the commercial bank itself and to the other intermediary. In India itself, the bank rate is used for the two purposes. One, it is for the rediscounting of the bills, and the other one, it is related to penalty being charged on the shortfall of the CRR or SLR. Shortfall on the if there is shortfall of the CRR and SLR, in that particular case the penalty is charged at the bank rate itself. Okay, so changes in the bank rate are often used by the central bank so as to control the money supply, because the rate of interest that is related to bank rate, that basically is a definition is related to what? The definition is related to that the amount, that the rate at which the amount is being lent to the banks itself or lent to the financial institution itself. Okay, but now in India it is having a very limited usage. Okay, and further the basic factor it is related to the structure of the interest rates is administered by the Reserve Bank of India. The structure of the interest rates is administered by the Reserve Bank of India, and these are not automatically linked to the bank rate. So the lending which is basically over there, which is basically done by the bank itself, it is not linked to the bank rate. That is why it is having no impact on it. And also the loans which are basically lent by the Reserve Bank of India to the banks itself, those are not basically automatically linked to the bank rate itself. And further, commercial banks do enjoy a specific refinance facility, and further those necessarily rediscount their eligible securities with the Reserve Bank of India at the bank rate. Now these basically the refinance facility which are available to the bank itself, those are basically rediscounted at the bank rate itself. The bill market is under development and not quite there is no basically that is not there quite improvement in the bill market itself. The most of the lending is still based upon the securities itself, and it is not by the by creation of what charge is created on the actionable claim is created on the book debt itself. What charge is created in the case of the book debts? Kindly please let me know. Kindly please let me know at the earliest that what charge is created in the case of the book debts. So you have to answer at the earliest. So I'll give a rest to my throat. It's over here asking you people related to that what charge is created on the book debts. I know it is not somewhat related over here, but you all must be knowing that in the case of the book debts, the assignment charge is created. Which charge is created? The assignment charge is created, or hypothecation can also be created. Hypothecation charge can also be created. Both of these can be created over there. So you must be keeping in mind either it is the assignment charge or the hypothecation charge is created in the case of the book debts. But that basic market is underdeveloped. Okay, that is why it is not basically used that much. Further, it is related to the second tool that we are going to learn about. It is a CRR. CRR is defined under what section and what act? Kindly please do let me know at the earliest. So CRR, it is a cash reserve ratio. CRR, it is a cash reserve ratio. No lien is not created on the book debts. It's the assignment or hypothecation. It's the assignment or hypothecation, not the lien. Very right, very right. So Shiv Vishnu has answered the correctly answer at the earliest, and also Kailash Khomane has answered correctly. So CRR is defined under section 42. CRR is defined under section 42 of the Reserve Bank of India Act. Reserve Bank of India Act. Okay, and also let me tell you under the CRR, a fraction of the net demand and time liabilities, that is NDTL, is to be maintained with the banks in the form of the is to be maintained with the Reserve Bank of India in the form of the cash. Okay, so a portion of the NDTL is to be maintained by the banks with the Reserve Bank of India, that is basically the CRR itself. That is basically related to CRR itself. And how is the CRR used as a tool of credit control? Now, when RBI feels like that the money supply is increasing and they want to suck out the money from the system itself, they will be basically, the RBI will be increasing the CRR. RBI will be increasing the CRR. The effect of the increasing the CRR would be like that the banks would have to basically maintain more liquid assets, more cash with the Reserve Bank of India, itself, and further they will be having the lesser funds with them so as to lend out. Okay, so that is how the CRR acts as a tool for the credit control itself. So let us take the case that previously I was having 100 crores rupees in my hand and the CRR is at 3%. Let us take the case that the CRR is at 3%. I'm having net demand time liabilities of 100 crore rupees. Now I'm to maintain 3 crore rupees with the Reserve Bank of India, and further I'm having 97 crore rupees for the investment or lending purposes. But now the CRR is increased to 4%. Now it is increased to 4%. What does it mean? It means now I have to maintain 4 crore rupees with the Reserve Bank of India in the form of the cash, and I'm having 96 crore rupees with me for the lending purposes. Now in a way the credit is now controlled. The credit part is now controlled because the banks are to maintain more part with the Reserve Bank of India itself. Okay, so that is how the Reserve Bank of the CRR is used as a tool of the credit control. And let me tell you that whatsoever the balances are maintained with the Reserve Bank of India, no interest is paid on it. No interest is paid on it, and further there is no lower limit and no upper limit. There is no lower limit or no upper limit related to it. Okay. Then it is related to the statutory liquidity ratio. Next, it is related to the statutory liquidity ratio, that is a SLR. That is related to the SLR. Statutory liquidity ratio is defined under section 24 of the Banking Regulation Act. So SLR is defined under the Banking Regulation Act, and if we look at the components of the SLR, in case of the CRR, the banks were to maintain the balances with the Reserve Bank of India in the form of the cash only. But in the case of the SLR, the banks are to maintain a part of the NDTL, a part of the net demand and time liabilities in the form of the cash or gold or the government approved securities within the India. The balances are to be maintained. Okay, and the further this balance can be maintained in the form of the cash, in the form of the gold, or in the form of the approved securities. Okay, so the statutory liquidity ratio is determined as a percentage of the total demand and time liabilities. So what are the demand liabilities? So if we are basically talking about the saving fund balances or the current account balances or the overdue FDRs, the term deposit receipts, that is basically related to what? That is related to the demand liabilities. And when we are talking about the time liabilities, it is related to the term deposits. Which is not basically available right now. Okay, so which the banks are liable to pay the consumer on their anytime demand, that is related to the demand deposit, and further the liabilities that the banks are liable to pay within a 1 month times due to completion of the maturity period are considered to be time liabilities. Okay, so that is related to time liabilities. And what are the objectives of the SLR? First of all, so as to control the expansion of bank credit. Same example as I already gave you in the form of the CRR. The CRR and SLR are basically, in case of CRR, the component is related to cash only, but in the case of the SLR, the components can be in the form of the cash, in the form of the gold, or the approved government unencumbered securities. Okay, the word I'm using, approved government unencumbered security. What does unencumbered means? Unencumbered means those securities on which any prior charge is not over there, on which not any prior charges is not already created. Okay, so that is related to, that can be maintained in those particular form. So if you're maintaining these particular assets, you are having lesser lendable assets. So if the SLR is increased, banks will be having lesser assets with them so as to invest in the case of lending itself. So in a way, the Reserve Bank of India can control the expansion of the bank credit. Further, by changing the level of statutory liquidity ratio, Reserve Bank of India can increase or decrease the bank credit expansion. Further, it ensures the solvency of the commercial banks, because the banks are basically risk-taking institutes, because at every level, at every inch, risk is available over there, whether it is related to the credit risk, counterparty risk, operational risk, strategic risk, reputational risk, market risk, interest rate risk, whatsoever the types of risks are over there. The banks is basically playing with all these particular risks, and banks need to maintain some of the capital so as to maintain the solvency. Okay, because in the rough times, in the severe times, it may be the case that bank is not having the funds so as to fulfill their obligations. The obligation is over there, over the bank is related to what? Related to whatsoever the deposits are being accepted by the bank on the demand or otherwise. The bank are to pay those deposits. Is that clear? Further, Reserve Bank of India in a way compels the commercial banks to invest into government securities like government bonds. So it is a way by which indirectly, not by this particular hand, but by this particular virtue, the Reserve Bank of India compels the banks that they can do invest into the government securities. Why the banks would be investing into government securities? Because if we look at the cash factor, it is earning no interest. If we look at the gold, it is earning no interest. But if we look at the government securities, those are earning interest somewhat now. So why we would be basically keeping our money vacant? We will be basically investing into those securities which are at least earning us something. Okay, so that is why, this is how the banks are compelled so as to invest into the government securities like the government bonds itself. Is that clear? Further, it is related to MSS, that is a market stabilization scheme, or we can set it to be a sterilization scheme itself. It is basically the sterilization scheme. To understand this, we need to take a look back at the year 2004, where the foreign institutional investors started bringing in dollars to buy the Indian stocks. So in 1992, those were permitted. FII, that is a foreign institutional investors, were permitted that they can do invest into the primary market or into the secondary market also. Okay, so now this resulted into the oversupply of USDs in the market. So what actually happened? The USDs were overflowing into the market. The system was having surplus of the funds in the economy itself. Now RBI did what? RBI bought the dollars. Thus creating an equivalent amount of rupee. So actually there was huge inflow of the USDs. And further there was a surplus of the funds in the economy itself, that is related to the USD funds. Now RBI purchased the USDs, and equivalent amount of the rupee were now available in the market. Itself. So as a response to the large scale capital inflows, because actually if there is a surplus of money, that will basically lead to what? That will basically lead to that the interest rates will fall down, and further related to all the economic problems over there. So as to manage the liquidity, Reserve Bank of India introduced the market stabilization scheme. Reserve Bank of India basically introduced the market stabilization scheme. So under this particular scheme, government issued the existing instruments. Such as treasury bills, dated securities by way of auctions under the MSS scheme. So if the government will be selling something, definitely the investors will be paying the amount to the government itself, and further the money will be sucked out from the economy itself. Okay, so schedule of issuance of treasury bills, dated securities on a quarterly basis is being announced. So that is related to what? That is related to the MSS, that is a market stabilization scheme. That was related to the fact that there was great inflow, there was a surplus of the inflows in the USD into the market itself. Reserve Bank of India basically purchased the USD, and there was equivalent amount of the rupee which were available over there, which was basically related to the economic instability, due to which the Reserve Bank of India had a duty so as to suck out the extra money supply from the economy itself. So they issued the already issued instrument. They issued basically the instruments, those were related to the treasury bills and the other instruments, and further that helped so as to contract the policy was contractionary policy in that particular case. Okay. Now the next it is related to the repo rate, that is a repurchase offer. Repo rate, that is a repurchase offer. What is actually repurchase offer? Let us understand it with an example. Now let us take the case that the bank A is having the surplus of the securities over here. The bank A is having the surplus of the securities, but it do requires some liquidity for some particular period. It does require the liquidity for some particular period. In that case, it will be placing it as securities with the Reserve Bank of India, and further it will be basically selling the securities to the Reserve Bank of India, and it will be purchasing back the security at a predetermined price after a predetermined period. It will be basically purchasing these securities. So here the securities are sold to the Reserve Bank of India, and further there is a agreement in between these two that the bank A will be purchasing these securities. The bank A will be purchasing these securities after a particular period and at a predetermined price. Okay, and further the Reserve Bank of India, because the securities have been sold by person A by the bank A to the Reserve Bank of India, so Reserve Bank of India will be providing liquidity to the person A over here. It will be providing the liquidity to the bank A over here. That is related to what? That is related to the repo transaction. That is related to the repo transaction. So repurchase offer rate is a rate at which Reserve Bank of India lends short-term money to the bank. So whatsoever the amount is being lent to the bank, that is basically related to what? That is related to the, that is for the short-term purposes. That is for the short-term purposes. So the short-term money is lent to the bank over here. That is under the repo transaction. And further, if the repo rate is increased, let us take the case that the previously rate was applicable at 7% or 6%. We will take it as the repo which was available. Let us take the case it was available at 6%. But now the Reserve Bank of India, let us take the case that the repo increased to 7%. Now previously the bank was able to borrow the money from the Reserve Bank of India at 6%. But now the borrowing is basically what? Now the borrowing is expensive. Now the borrowing is expensive. If RBI wants to make it more expensive for the banks to borrow the money, it increases the repo rate. It increases the repo rate, and further, if the RBI wants the banks to make the borrowing not expensive and further cheaper, in that case, it basically decreases the repo rate. It decreases the repo rate. Now the rate at which the funds will be available with the bank will be lending as per those rates. Let us take the case that the if we consider the previous scenario in which the repo was 6%. In that case, bank maintaining 3% margin can lend the funds at 9%. Whereas in the case if the repo rate is now increased to 7%, so as to bank to maintain the same margin of 3%, now it will be able to lend at 10%. So in a way, it basically increasing the lendable rates. It is basically increasing the lendable rates by virtue of the repo rate. Now if the lending rate is increased, lesser people would be basically likely be taking the credit from the bank itself. Now if the lending rate is increased, definitely the lesser people will be borrowing the amounts from the bank itself. Okay, so that is a scenario related to the repo rate. So that is a scenario related to the repo rate, and the reverse of the same is called to be reverse repo rate. And the difference between the repo rate and the reverse repo rate is the interest corridor. So as the income which is earned by the Reserve Bank of India is the reverse repo, that is a interest corridor. Okay, so in the case the banks which are having the higher deposits or surplus deposits, they do park their surplus funds with the Reserve Bank of India. They do park the surplus funds with the Reserve Bank of India, and further Reserve Bank of India gives them security for this particular purpose. Reserve Bank of India do give them securities for this particular purpose, and further there is an agreement between these two that the Reserve Bank of India will be basically keeping back the securities after some particular period. So the money will be returned to the after some particular period will be returned to the bank over here, and further the securities will be returned back to the Reserve Bank of India. So the inverse of the repo transaction is a reverse repo transaction. Inverse of the repo transaction is a reverse repo transaction. So RBI uses this tool when it feels that there is too much money floating in the banking system. Let us take the case that the banks are having the surplus of the money. In that case, it will be increasing the reverse repo rate. It will be increasing the reverse repo rate. So if the repo rate is increased, in that reverse repo rate is increased, in that particular case, the banks would be looking at the earning avenue. They will be basically keeping their surplus fund with the Reserve Bank of India so as to earn the reverse repo rate. Okay, so in that case, Reserve Bank of India will be increasing the reverse repo rate. Is that clear? So an increase in the reserve repo rate means Reserve Bank of India will borrow money from the banks at higher rate of interest. That the Reserve Bank of India will be borrowing money from the banks at the higher rate of interest. And if the reverse repo rate is decreased, what does it mean? That the Reserve Bank of India is going to borrow money from the banks at a lower rate of interest. If a lower rate of interest is being followed by the banks to the Reserve Bank of India, by the Reserve Bank of India to the banks, in that particular case, lesser banks will be keeping their deposit with the Reserve Bank of India. So that is related to the repo rate and the reverse repo rate. So the conclusion we can draw from over here, that repo rate signifies at which the liquidity is injected into the banking system. So repo rate is basically related to what? By a way, it is a way by which the banks do borrow from the market, borrow from the Reserve Bank of India, and reverse repo rate is a way by which the banks do place their excessive deposits with the RBI itself. Okay, so that is related to the repo rate and further the reverse repo rate. Is that clear? Then it is related to the open market operations. Then it is related to the open market operations. Now, what are open market operations? When you are selling and purchasing in the open market, as in the auction system itself, that is related to what? That is related to the open market operations. Okay, so in the case of the open market operations, Reserve Bank of India do buy and sell the government bonds in the secondary market. So we are not talking about the primary market over here. So Reserve Bank of India is indulged into the sale and purchase of the government securities, government bonds in the secondary market, where if Reserve Bank of India wants to suck out the money supply from the market itself, it will be doing what? It will be selling the government bonds. It will be selling the government bonds. So investors will be paying money to the Reserve Bank of India, and ultimately it will be contracting the money supply in the market itself. And if you want to expand the market, if they want to basically expand the market, in that case, the Reserve Bank of India will be selling the government bonds. So the Reserve Bank of India will be selling the government bonds. By that particular manner, the Reserve Bank of India is basically doing what? The Reserve Bank of India will be basically not selling, actually it will be purchasing. It will be purchasing the government bonds from the market. By way of purchasing the government bonds from the market itself, it is basically pumping out the money supply into the market. Pumping out the money supply into the market, that is related to the open market operations. Next, it is related to Reserve Bank of India monetary policy aims to achieve the following objectives. Let us have a look at it, that what are these different objectives. First of all, monitor the global and domestic economic conditions. That we need to look at the global and domestic conditions. We need to have a match in between them, and further we need to respond to these swiftly. Further, we need to ensure higher bank credit expansion to achieve higher growth. We want that higher growth must be there, higher bank credit expansion must be there, but we also at the same time we need to protect the credit quality too. That can be done if the more lendable funds are over there with the banks. Bank would be lending very hastily, but that is also not required, because it creates an inherent risk in the market itself if the banks are lending at a very high pace. Okay, so we must be maintaining the price stability and the financial stability related to the give thrust to the interest rate management, liquidity management, inflation management, because by way of the demand and supply of the money, all these are related, whether it is related to the interest rate, whether it is related to the inflation, whether it is related to the liquidity, all are interrelated. So that would be all about this particular video, and in the next video we will be learning related to the fiscal policy and further related to the GDP concepts.